Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. At the onset, from all of us here at NDTV Profit, I'd like to wish you and your family a very, very happy Diwali. And our heartfelt wishes that Goddess Lakshmi blesses your homes, not just for the coming Samvat, but for the many years from here on out. Now, this is a festival of hope, a festival of light, and invariably, there is a reason to be optimistic. There is a reason to be happy. And so I thought, why don't we talk about how the markets are right now, how the investment landscape is looking, and whether or not the signs are pointing to the reality also being optimistic. We've got Nimesh Chandan, who is Chief Investment Officer of Bajaj Finserv AMC, joining in today. Nimesh, at the onset, let me wish you and your team and your family a very happy Diwali.
Thank you, Alex. Always good to be on your show. From my side too, to you, your family, and your viewers, a very Shubh Deepavali, and wish you a very prosperous and profitable New Year.
Yeah, and I wish that for you as well, because in extension, then I'm wishing my viewers well. So let me ask you this. Generally, when we head into the festive season, people let their hair down. There's a tendency to look at the glass half full, and whether or not that's the case in the rest of the year, it certainly is the case now. The question is, do you see that the trends that you're seeing, and particularly we're speaking on a day when the markets are cheering, we've had a few great days, and we're looking at very close to 26,000 on the benchmark Nifty 50, way better than we've looked at any point in the recent past. Are the signs pointing upwards, Nimesh?
Alex, as a fund house, as Bajaj Finserv AMC, we have been now positive for 7 months. Fortunately, I have timelines placed when I had come to your channel earlier, where we had a very bullish conversation, both in your show and as well as your colleagues. From the time the tariffs were discussed, we had given a bullish call on the market that this is a buy on dips market. As a long-term investor, you benefit from this noise and this high decibel tweets that come, but those have very limited impact on the economy and on earnings in Nifty especially. In fact, people were ignoring the kind of efforts that government and RBI was putting in boosting growth in the economy by rate cuts, by direct tax cuts. A lot of before GST also, a lot of steps were taken in terms of announcing, say, the eighth pay commission, in a lot of handouts which were given by different states. So there was a stimulus of about 2% before the GST cut, and hence we thought this is the time to accumulate, because the second half of this year is likely to be great, and GST came as an icing on the cake. And from here on, you've seen consumption pick up and businesses looking to invest more. So as you said, half glass full, now it's more like confirming that yes, we are on a more bullish setup.
Delve a little deeper into some of these things, because it helps to set the context and the expectations for the new year as well. And in that, we're bang in the middle of the earnings season. Are you pleased with some of the early signs that you're seeing, particularly because, Nimesh, and the tendency, of course, for investors has been to go into the broader markets. And this is simply because of the way that the broader markets funds performed heading into the end of the last Samvat. They were a little disappointed in 2081. And the large caps have actually outperformed. I think the earnings also kind of pointed to that. Would you say that that is being built into right now? What are you seeing on the earnings front?
So let's track a little bit from, say, last Samvat and maybe a month before that, when markets peaked at around 26,300 Nifty. From there on, we saw flows being negative. FIIs were selling continuously for now about a year now, but very intensely between last October to, say, February of this year, or maybe even a few days in March. You saw economic numbers slowing down because last year GDP took a knock in the first half, We had long elections, government spending started a bit late. A lot of corporates were on a slow beginning of the year because of, say, floods in certain areas, certain goods and services were impacted. So, full year estimates were revised downward very sharply for Nifty earnings. We saw then worries of tariff coming in and people actually derating the Indian market. So when people were not able to really put a number to this will be the tariff and this will be the impact on Indian corporates, typically under worries and fear, people reduce the multiples that they give to any market. So while Nifty earnings from March onwards did not see much downgrades, but what you saw was the PE derating of the market. Now, the corollary to that is that if these worries go away, the market should ideally re-rate upwards. And we saw many reasons why we were looking for a better H2. So let's start from the budget onwards at the beginning of the calendar year, direct tax cuts, and we saw the impact of that coming from April onwards. We saw RBI starting to cut rates and infuse more liquidity into the system from February onwards, and you now are starting to see the rates being percolating into, say, your home loan rates being coming down, immediate savings in EMIs that are coming in. We saw liquidity being positive, also increase economic activity, government spending on capex continuing. And as consumption is expected to move up and capacity utilizations have moved up, private capex is also starting to emerge. In between, we also saw the gold as a wealth effect coming to Indian households. We are among the largest investors of gold as households. So that impact will come in terms of maybe they will not sell gold, but leveraging gold for either business purposes or in terms of consumption purpose. So balance sheets have gotten better. Uh, the GST added another green shoot or another uh, incentive for people to go and spend. So this Diwali festival suddenly became a GST festival, and all these things, if you combine together, they are boosting consumption, they are boosting economic growth. Yes, we are not saying there's no impact of tariffs. The high tariffs that have been put are affecting certain sectors. But if you take the whole GDP and corporate earnings together, it's a very small impact. And the valuation took a bigger hit because of that. Hopefully, in the next month or so, we should get some good news. I'm hopeful, and from what I hear in the media, I'm hopeful that we have some agreement with the US. And even if these penalty tariffs go away, then there is enough and more to play.
Okay. So, and I'm glad you've given the context as you see it, right? So, Nimesh, the question is, how, in your opinion, should people be deploying from here on to capture that? As I said, and we've spoken a lot about behavioral investing, right? The tendency is to rush after things that have done well in the recent past, but that didn't work over the last 1 year. Certain sectoral and thematic funds which people got into whole hog have not done what was anticipated. The broader market funds may not have performed as well as people had anticipated. Large and mid cap funds have actually done reasonably well. How do you think things are going to pan out in not necessarily the coming year, because you don't have that short a time frame, but in your opinion, how do you think that things are panning out over the next year and a half to two?
So, Alex, you're absolutely right. People have this recency bias. And I'll just give an anecdote. I was speaking to a few investors about the consumption picking up. And most of the time, the question was whether this sector benefits from GST cut or doesn't benefit from the GST cut. People have not taken the whole income effect, wealth effect that has been created by multiple steps that have been taken. So people need to look a little longer term, rather have that recency bias. And then you have many sectors which have been undervalued or underperformed for the last 2 years, and they can do better. Whether it is home improvements, say as a segment, there are many white goods companies or consumer electronic companies that have not done well for the last 2 years because the market was looking at capex stories or certain very narrow themes like defense or railways or so. So these are the areas where you have quality companies with scalability, good ROEs, good cash flows available. So consumption baskets needs to be spread up or opened up to include everything from quick commerce, FMCG till real estate, and there are many opportunities within that. We can also have certain consumer facing NBFCs contributing to that, or consumer facing, say, insurance companies coming in. Capital marketplace, they have underperformed recently. They will come up as an important place to look for. And there are certain contra bets that we have taken in, especially materials, where we are bullish on metals. We are selectively bullish on chemical companies. They have been underperformers for like 3 years now. And many of them are available at replacement cost or at book values or NAV values that we calculate for them. So those are the areas to now explore, be a little contrarian at
Yeah.
heart, pick up some of the companies that have not done so well in the last 3 years.
Have you done that? And I want to specifically focus, Nimesh, on three schemes that you have under your umbrella, which is both of the diversified funds. You're talking about the multi-cap fund and the flexi-cap fund. And I also want to ask you about the multi-asset fund, because even those, and I want to start with the last first, even those mutual fund schemes and fund managers of multi-asset funds that had a strong view on gold, say in February or March of this year, they've trimmed their positions. They've cut their gold allocation because they thought, how much further can this yellow metal run? And it has defied all expectations. I'm just wondering what your allocation strategy there is, and how are you positioned in your multi-cap and your flexi-cap fund?
So in multi-asset first, as you mentioned, we'll start with that. In multi-asset, last year we had moved substantially into gold because we saw two reasons for gold getting the benefit or attracting more investors. One, gold does well as a safe haven during uncertainties. If there are wars, if there are concerns on geopolitical issues, people typically would hide in gold. So gold would do well there. Second, we were seeing central banks accumulate a lot of gold, maybe de-risk themselves from dollar a little bit, and hence there was a lot of gold buying by central banks. Almost last year it was about 25% of the total traded volumes of gold in the world. So we picked up gold at that time. In the beginning of the calendar year, somewhere in January, we actually added silver because we found that silver as a ratio to gold was at a decade low or so. It was severely undervalued. See, gold, silver has two characteristics. It has characteristics of the precious metal. It also has characteristics of the industrial metal. And we are seeing some pickup in growth coming in emerging markets and in electronics and technology. So we thought silver will also start gaining well. So I think that call went very well for us. Now, recently, what we saw as a squeeze in silver in terms of cash market and spot market, and silver rising substantially. Even we've taken some profits of that. Gold, if you see, the uncertainties now are coming down. So now it is more like a dollar play and central bank buying rather than a pure uncertainty kind of a play or a safe haven play, which means there could be a bit of correction there. Coming to FlexiCap, as you know, our FlexiCap fund, we invest based on mega trends, and we believe BFSI, consumption, and healthcare. These are the three big mega trends to bet on. Within CapEx, we are bullish on the subsector of power equipments. So these are the four mega trends we are betting on in FlexiCap. Our multi-cap fund is a contra fund. Here you will find those sectors and companies that are going through some tough period, but are available at a good valuation. So here you will find companies in, say, materials segment, in home improvements, paints, cables and wires, and so on. So those are value picks in a contrarian market.
And just a last question, right? Every fund manager, CIO that I call onto my program, I give them a chance to talk to their investors directly. And so, one, of course, you've already wished them a prosperous new year, but some part of that you also have to play. So the question is, as we enter this new Samvat, where are you benchmarking your return expectations, and where do you think they should set their expectations?
See, typically markets follow earnings growth. If you look at markets from 2004 to 2025, you will find for major indices, earnings have multiplied about 13 times, and these benchmarks have also multiplied 13 times. So short term, there may be some deviations, but in the long term, markets follow earnings growth. in the next year. So in FY26, we are expecting about 9 to 10% earnings growth, and FY27, we are expecting between 12 to 15% kind of earnings growth. So if markets were just to follow the earnings growth in 1 year, in the next Samvat, possibly we get that kind of a gain of about 12 to 15%. I think that's the kind of expectation one should go with. Ideally, if you are a long-term investor, you should look at equity investments beating investments in fixed income and in beating inflation. So that's the kind of expectation one should have. If there is any dip in the market, and we can sense some global volatility in the last few days, if that persists, India may be affected a little bit, but that should be used as an opportunity to add to the exposure. Think long term, and much of this volatility will start looking like opportunities rather than worries. I generally tell people, if you're a short term trader, this market is a ranbhumi, it's like a battlefield. But if you're a long term investor, this is like a rangbhumi, like a nice entertainment for you in the short term and a good entertainment and wealth creation in the longer term.
Well put, well put. Thanks so much for joining me today and for speaking to me as always. Pleasure speaking with you.
Thank you.